You bought a $2 coffee. Your bank charged you $35 for it. That's not a mistake. That's the business model. Here's a stat that should bother you. Nearly 47% of everything a U.S. bank earns now comes from fees, not loans, not interest. Back in the 1980s, that number was around 30%. Banks didn't get worse at lending. They got better at something else, turning your habits into their revenue. There used to be a joke called the 363 rule. Pay depositors 3%, charge borrowers 6%, and be on the golf course by 3 p.m. Banking was boring. Then deregulation and new technology opened a more profitable door. Fees built around things you do every single day: swiping your card, checking your balance, dipping a dollar below zero. Payment services, your everyday debit swipes, ATM withdrawals, checking fees, are still the single biggest source of bank fee income. Not Wall Street deals, your daily life. Look at your credit card statement. See that minimum payment box? That's anchoring. Your brain fixates on the small number, not the real balance. Pay only the minimum on a $5,000 balance at 22% interest, and you could be paying it off for over a decade, for purchases you don't even remember making. Then there's mental accounting. A $1,200 tax refund feels like bonus money, so you spend it. The same $100 in a paycheck feels like income, so you save it. Same dollars, different label, completely different behavior. That's exactly why sign-up bonuses exist. Free money is designed to be spent, and spending triggers more fees. And buy now, pay later. That's present bias, engineered. 4 easy payments of $25 makes your brain register only the first $25. The full $100 debt doesn't feel real until it already belongs to you. Back to that coffee. Your bank covers a $1 shortfall, then charges you $35 for the favor. Work out that interest rate, it would embarrass a loan shark. It gets worse. For years, some banks processed your largest transactions before your smaller ones on the same day, draining your balance faster so a single bad day could trigger multiple overdraft fees instead of one. And notice the language, it's never called a penalty, it's called protection. Nobody signs up for a punishment plan. Everyone signs up for protection. That's not customer service. That's word choice as product design. Regulators noticed. The CFPB has been cracking down on what it calls phantom opt-ins, cases where banks claimed you'd agreed to overdraft fees but couldn't prove it. Under the Electronic Fund Transfer Act, a bank legally cannot charge you an overdraft fee on a debit or ATM transaction unless you affirmatively opted in. Not assumed, opted in. And banks have paid for skipping that step. TD Bank settled for $122 million over deceptive overdraft enrollment. Atlantic Union Bank paid $6.2 million in penalties. The CFPB estimates these reforms are now saving consumers roughly $4 billion a year. Some major banks have eliminated overdraft fees entirely. PNC, for instance, added a 24-hour grace window before any fee hits. As Warren Buffett put it, price is what you pay, value is what you get. Overdraft protection was never sold on value, it was sold on framing. Here's your action right now. Open your banking app and check whether you're opted into overdraft coverage on everyday debit purchases. If you don't remember opting in, you may never have. And if you did, you can opt out in about 2 minutes for free and simply let a declined transaction decline instead of protecting you into a $35 hole. Your bank isn't evil, it's a business, and businesses respond to incentives. Right now, the incentive is built around your habits, not your goals. But once you can see the mechanism, you can opt out of it. If this changed how you look at your bank account, hit subscribe. I'm going to keep pulling back the curtain on how money actually moves. And drop a comment. Have you ever been hit with a surprise overdraft fee? Tell me the story. See you in the next one.